It begins, as all empires do, not with a crown or an army, but with a calculation. In the narrow streets of Frankfurt in the late 1700s, a Jewish merchant named Meyer Amschel Rothschild kept ledgers instead of weapons, numbers instead of soldiers. His clients were princes who needed loans to wage wars they could no longer afford. Gold moved faster than armies, and Meyer learned that whoever controlled credit, controlled kings. From his counting room grew a dynasty that would stretch across Europe. He trained his 5 sons like generals and dispatched them to the capitals of the age, London, Paris, Vienna, Naples, Frankfurt, each to run a branch of the family bank. They didn't need borders, they built networks. Couriers, coded letters, and sealed chests of coin became the arteries of a new power. While monarchs gambled with wars, the Rothschilds calculated interest. When Napoleon marched across Europe, they financed both sides. They sold bonds to Britain, carried bullion for Austria, and brokered peace when the cannons stopped. Governments fell, empires collapsed, but their ledgers only grew. Money became the world's true empire. And its capital wasn't a city, it was trust. To lend a nation millions required faith that would outlast kings, and the Rothschild seal provided that. Soon, other families followed, the Barings in Britain, the Oppenheims in Germany, the Warburgs and Lazards in France. Europe was becoming a web of financiers who could move empires with a telegram. By 1830, the system was alive, a quiet organism breathing beneath politics. And as the Industrial Revolution roared, it found new limbs, railroads, steelworks, and telegraphs. Credit built factories faster than labor could fill them. The modern world was being born in the ledgers of men who never stood for election. It wasn't conspiracy, it was evolution. Power was changing shape, from hereditary rule to financial architecture. A monarch's crown could be lost in a coup, a banker's power lived in paper, and paper could be moved anywhere. Still, every empire fears exposure. And so, secrecy became tradition. Private ledgers. Silent partnerships. Family marriages that kept control within the bloodline. While the public saw progress, the foundation of that progress, ownership, slipped from sight. The world was entering a new age, one where wealth could travel invisibly, and nations would one day find themselves governed not only by laws, but by loans. The empire of credit. By the middle of the 19th century, the Rothschild name had become more than a family crest, it was a currency in itself. Their letters crossed Europe faster than official couriers. Their coded telegrams connected London, Paris, Vienna, Frankfurt, and Naples in a web of gold and influence that no king could untangle. They financed wars and then financed peace. When governments ran out of money, they turned not to monarchs but to men like Nathan Rothschild, who could raise millions overnight through bond issues. In that quiet moment, the center of power began to shift, from crowns to capital. The Rothschilds were not alone for long. Across the Atlantic, a new empire of oil, steel, and ambition was rising. In America, John D. Rockefeller transformed black crude into golden power. Standard Oil grew like a living organism, swallowing competitors, pipelines, and refineries until it controlled more than 90% of the U.S. petroleum market. Rockefeller's genius was not invention, it was integration. He saw that control of infrastructure was control of destiny. Railroads, shipping routes, even politicians, all could be bent toward efficiency, and efficiency meant monopoly. As profit soared, so did philanthropy. But Rockefeller's charity was as strategic as his business. Through the Rockefeller Foundation, he shaped universities, medical research, and public policy. He funded causes that aligned with a future he could predict, or design. Meanwhile, in finance, J.P. Morgan was writing a new chapter of consolidation. The Morgan Bank rescued the U.S. government in the Panic of 1895, selling gold to stabilize the treasury. It was a private bailout before such a word existed. When markets trembled, presidents called bankers. By 1907, the United States teetered on collapse. The stock market crashed, trust companies failed, and panic flooded Wall Street. Morgan gathered the country's most powerful financiers in his library, locked the doors, and refused to let them leave until they saved the system. Overnight, a private consortium of bankers acted as the nation's central bank, a role too big to remain unofficial. From that crisis was born the Federal Reserve System in 1913, a central bank designed to stabilize the economy, but structured in a way that kept it curiously insulated from direct democratic control. Public in purpose, private in ownership, the Fed was a perfect hybrid of state and capital. And across the ocean, similar institutions were taking shape: the Bank of England, the Banque de France, the Reichsbank, each weaving financial stability into the fabric of governance. But stability had a price: dependence. Nations that once ruled through armies now ruled through interest rates. The First World War exploded across Europe in 1914, and suddenly, credit became the new ammunition. War bonds, loans, and supply contracts turned financiers into quartermasters of empires. The same bankers who had funded industrial growth now funded destruction and reconstruction alike. When the guns fell silent in 1918, the balance of power had shifted again. Europe was in ruins, and America held the purse strings. Wall Street emerged as the new center of global finance, and New York replaced London as the heart of modern capitalism. The invisible hand of the market now had names: Morgan, Rockefeller, Warburg, Kuhn-Leib, and dozens of other families who formed a financial aristocracy without thrones. But the system they built had another, subtler feature: opacity. By the 1920s, new corporate laws allowed companies to exist as separate legal persons. Trusts could own subsidiaries, and subsidiaries could own each other, creating endless loops of ownership that hid the true controller. A family could hold an empire through just a handful of shell entities and nominee directors. In Switzerland, numbered accounts began to appear, discreet, untraceable, and immune to political storms. The tiny Alpine nation became the vault of the world, protecting fortunes from revolutions, wars, and taxes alike. In the Caribbean, another innovation was born: offshore finance. British colonies like the Cayman Islands and Bermuda realized that secrecy could be profitable. With minimal regulation and generous privacy laws, they offered global elites a place to park money unseen. By the time the Great Depression struck in 1929, the hidden architecture was already mature. Millions of ordinary people lost homes, jobs, and savings, but the largest fortunes survived, sheltered by trusts and diversified assets. The crisis did not end the system, it refined it. Franklin D. Roosevelt's New Deal tried to tame the financial dragons with regulation, but capital always finds a crack in any cage. Wealth flowed into new instruments, new jurisdictions, new currencies. The age of global finance was truly born. Behind the visible headlines, stock tickers, recessions, reforms, another layer of continuity endured. The families that had once controlled banks now controlled institutions. They became stewards of foundations, boards, and think tanks that quietly shaped policy. When World War II erupted, these same networks mobilized again. American banks financed production, European firms retooled for survival. The war ended with a new order not of empires but of systems: the Bretton Woods Agreement, the World Bank, and the International Monetary Fund. It was the beginning of a coordinated global economy, and the end of financial isolation. The invisible web had gone international.